Yeah, it's okay, fine. We'll keep the mics on, sir. We'll be on for
No problem. No problem.
Kunal, let's begin now.
Okay, am I audible?
Just stop the animation before you begin.
Okay, just a moment. Has it stopped?
Yeah.
Okay, great. So the recording is on, right? Okay.
Yeah.
So hello everyone. Welcome to the first episode of Sundarbans Summit with Mr. R. Srinivasan sir here with us. Mr. R. Srinivasan is currently the Chief Investment Officer at SBI Mutual Funds. He is also one of the top mutual fund managers in India. He has more than 30 years of experience in equities. He currently manages over 1.5 lakh crore INR in SBI Mutual Funds, with funds like SBI Magnum Global, Small Cap Fund Direct Growth, and much more. He has consistently outperformed the indices ever since joining SBI in 2009 as a senior fund manager and later going on to become the chief equity head and the chief investment officer now. The list of achievements for Srinivasan sir can go on forever, but unfortunately not this session. So I request Anshuman Bhasin, the Secretary of Finance Club and equity analyst at the leading family office fund based in New Delhi, to take over. Over to you, Anshuman.
Thank you so much, Kunal. Okay, sir. Sir, let's just jump right into it. Describe when you were on the come up, who were your key influences in your investment learning?
ऐसा कोई खास नहीं था यार. I mean, so I came into this whole profession by default. I never used to know what capital markets were actually. But एक बार आ गया तो I kind of got interested, and I read the same books that you guys now hear about. I heard about Warren Buffett, Charlie Munger, Joel Greenblatt. ये सब इंटरनेट में तभी इतना था भी नहीं इंटरनेट. ये सब पढ़ के I got interested. Generally speaking, the job was interesting, so I think the job kind of pulled me into it. I had an option between some sales job and this job. The reason I took up this job was very different. So मैं नहीं बोलूँगा यहाँ पे. But it had nothing related to do with investing. But it was an interesting job. As in, we were meeting interesting people, heads of companies. People spend time with you, explaining their business strategies. So, and you get paid for it. So, you kind of pull me in. But there's a hero, nothing. But people, a lot of people who kind of inspired me in the journey, and a lot of people who continue to inspire me.
Right, amazing. So, can you describe your investment style and your investment philosophy to us?
Okay, so I work in a mutual fund. So we don't necessarily follow one investment philosophy. We have multiple funds. We run different philosophies. But let me kind of answer this question differently. So I'll kind of give you the holy grail of what works in investing. So both and everybody hold your breath. Yes. This is the only thing that works. This is what you have to do to make money.
Yes, sir.
Okay. 3 things. Buy a good business model, run by good guys, at a reasonable valuation.
And I mean, all the wisdom is right there. Buy a good business model, good people running it at a reasonable valuation. Okay, guys.
उतना ही करना है और कुछ नहीं करना है लाइफ में. And you have to give it time, and you have to go right. So there are multiple things, but so this is the holy. If you ask me, this is the holy grail of investing. This, if you want one, सब कुछ summarized in one sentence, this is how investing should be done. This is how you make money in investing. Right now, it is as cliched as it gets. Right? How much more cliched can you be while describing your investment philosophy? ये लोग जो सुन रहे हैं तो ठीक है, तो वीडियो में है तो स्माइल कर रहा है, अरे यार सही बोल रहा है, but who invests with crappy guys, right? Who wants to buy expensive? So ये क्या बोल रहा है यार? मतलब what's the big deal? This is something everybody knows. But this is what investing is. It is as simple as that. People kind of, I think, get carried away with a lot of stuff because their perspective is the kind of perspective is different, right? So somebody who wants to make quick money in a short period, he indulges in momentum trading, right?
Right.
So momentum investing is one part of it. So if you kind of analyze the stock returns, you'll find that momentum is a very big contributor of stock returns. If you break up factors in terms of, say, growth, value, momentum, and stuff like that. Right. And obviously then there are people who talk about being a contrarian investor, right? Basically do what the market
isn't doing.
Right? Then there are people who believe that the risk, large caps are less risky, small caps are very risky. So small cap maybe shouldn't invest, large cap may volatility is less. So ये सब सही है, and they're right and wrong at the same time. So if you think about investing from a long-term perspective, I think you should think compounding. This is how most people have made money. They've thought about investments as businesses that they own. They've thought about themselves as the guys who run the business, not necessarily who run the business, but as owners. And they kind of stayed on, and they've looked for factors that lets the business sustain over a very long period of time and make money as in return on capital. So if you just stick to this simple thesis, the reason why I mentioned this thesis is what is the most important is so that you are clear as an investor what is it that you're trying to achieve. If you are trying to achieve long-term compounding, long-term wealth, then broadly speaking, this is what you need to do. But this is actually not as simple as the way I put it across. Then you go into what constitutes a good business, right? Now, what is a good business? A good business, for example, is something that has competitive advantages, right? So you must have read about economic moats. Warren Buffett probably coined the term, right? So this is like a company which has a strong castle and it has a moat around it. So there are always the people trying to attack it, and you've got to have a moat that prevents it. So your moat is increasing, decreasing, right? But the first question to ask is there a moat in the first place? 95% probably more businesses have absolutely no competitive advantage. Right? धंधा कर रहे हैं, पैसा भी बना रहे हैं, but they do not have what is competitive advantage? It's a right to win. So Morningstar has classified some stuff. We have like 7 sources of economic moats. One of them, for example, it could be something as varying as market share, which gives you an advantage, scale, or something like network effect, depending on the business that you are, which gives you a kind of a flywheel in that business model. Or it could be something like in a pharmaceutical company, you have a technology, you have a regulatory advantage in terms of first to file, and then people can't come until the time the patent expires, right? So these are competitive advantages. Some are there is a defined competitive period. Some good businesses, for example, try to figure out how they should expand their moat, right? How they should increase their competitive advantages. Right to win. What is your right to win? कुछ भी चीज कर रहे हो ना? What is it that says that you have some edge based on which you can win this stuff that you're doing relative to the other guys? And there's something businesses need to think of. You need to think of as investors. So we look at 7 sources of economic moats, right? Less than 5% of our companies that we track has even one economic moat. That is only one part of a good business model. A good business model generates return on capital employed. Even if it does not generate accounting return on capital employed, the underlying business units on a unit economic basis generates return on capital employed. It's very important, right? Because you borrow money, the cost of capital is anywhere between 12-13%. You borrow money at 8-9%. You got to make more than that money. So your return on capital employed has to be more than your cost of equity or cost of capital. So return on capital. Second, third, for example, you look at not at accounting numbers, you look at cash flows. You got to make cash because cash is the raw material for the investment. Cash you got to be reliant on debtors, and hopefully you will get cash at stock that you pick, right? So if you are giving something terminal value, you better be sure that there is no disruption in that business. So let's say NTPC goes into thermal power. If you think that thermal power across the world is going to get replaced by renewables, or for that matter, past businesses which have got completely disrupted, a bookstore got disrupted by Amazon, and there are many such examples, right? So risk of disruption needs to be low as far as you can see it, right? The capital intensity ideally should be low, because if you get more capital and you're running negative working capital, then you need to borrow from outside. So a lot of these things, and the list we have like a 27-point checklist, and the list goes down into in terms of what constitutes a good business model. And you get the drift, right? It's not very easy to figure that out. But you got to go through each of these factors and subjectively assess how strong the business model is. Similarly, what constitutes a good management? I mean, obviously, you draw some conclusions based on meetings, but you really don't need meetings. You can look at track records. So we look at 20-year track records of companies. We look at volatility in that fundamental data, and we question why that volatility exists, and we get insights into the way the company runs the business, the secularity, the cyclicality of it. You can also cross-reference management in terms of their integrity, their track record, how transparent they are, how. So when you speak to people, right, you get a sense on their transparency, what they are thinking, and what you want to invest based on should kind of match. So if you are a long-term investor who's looking for longevity in the business model and you're looking for competitive advantages, then you need the management. You'll be surprised. Most businesses don't do focus on return on capital. They want to be number one. Now, if your investment philosophy doesn't care about the business being number one, it cares about it making economic returns, then you know that this is not a match. Right? They make your investment. So
Exactly.
management again can be, so even management risk needs to be figured out in terms of how much breadth there is. If in a large business, is it run by one guy? Is there the risk of that guy conking off, for example, with their breadth? And there are multiple points again. Valuation more important, and a good business and a good management. So I kind of tricked you by giving you this formula. A good business and a good management always is expensive, because you're not the only guy who understands that it's a good business. Unless you're looking at a small cap company, nobody has looked at. But generally that is not the case, right? So valuations again, valuations are much more complicated than just looking at PE ratios and price to books. So you guys should read this book, which is very relevant to what I'm saying right now. Narratives and Numbers by Damodar. Basically, you have an investment thesis on a business which revolves around the business model, and there is some view on the management there. You put that thesis into a cash flow model. If you ask me, in valuation is agnostic to asset classes and geographies. The way to look at it, and people say with technology company, should you value it differently? No, you don't need to value anything differently. You just have to figure out what your thesis is. It doesn't matter if it doesn't make cash. It might be in investment mode. At some point, it will make cash. So you just have to extend your second stage. So you run a 20-year second stage. You run a 25-year-old second stage. Obviously, the risk of running a higher second stage, DCF, is that you haven't. It's very tough to predict longer the timeline, which means the thesis in turn has to be extremely strong. The competitive advantage, there has to be a competitive advantage. Otherwise, how will you even say that the company will exist after 3 years? So valuation basically is putting your thesis into a cash flow model. And if that gives you a return which aligns with what you are expecting, then it is value. It doesn't matter if it trades at a 50 PE, right? A 50 PE stock may be high growth. Eventually, a PE is a function of three things: one, growth; second, return on capital; third is cost of equity. Right? Growth reduces effectively future PE because you're growing at a very fast pace, and your return on capital minus cost of equity, that combination along with growth can be crazy. I mean, it's like a test of both worlds. And if you can identify growth and you can identify high return on capital sustaining for a long time, that's you just go go blind and buy the stock.
Mhm.
So this is broadly, I'm sorry, I'll give you a long answer, but I thought you wanted me to on this
Absolutely.
question, so I explained something. Yeah.
Absolutely. I think this was the most important question, and we will do a deep dive on all of these momentum and all of these things, volatility and risk, and all of these things you mentioned. Before we get to anything, since we were talking about the PE multiple, would you also agree that the PE multiple is also a function of the going perception of the company and the sector at the moment?
Yeah, P multiple is just a result.
Right.
P multiple में you have a price.
Yes.
The price is a perception of a lot of stuff.
Right.
उसमें setup भी है, उसमें demand supply भी है, उसमें investor perception भी है, उसमें fundamentals भी है. E is what there is.
Yes.
It is just a heuristic. It's just a shortcut. A DCF gives you an implied P multiple, which would be different based on the return on capital, the cost of equity, the second stage, the longevity of that, the terminal growth that you apply, right? So P multiple is only a shortcut that people use, and this is very important to understand. Even price to book multiple.
Right. Yes, sir. Sir, so you mentioned that a lot of the returns in the stock are made in the momentum. So is there something? Is there some mechanism you use for tracking momentum, seeing which stocks are in momentum, which are out of momentum, like that?
No, I didn't say that. I said that if you break up returns,
Mhm.
eventually returns are made by getting your call on the business model right, getting your earnings call right over a long period, and buying it at the right price.
Right.
That is what makes a good investment. That is what eventually generates returns over a longer period. But if you statistically break the returns, then you can break it up into factors. So if you run, for example, a quant software, then you can break it up. So there are the value factor, there are growth factor, there are some things, there are certain styles that work in certain markets. So for like 11, 12 years, this was a growth market. So growth stocks, if you classify them such into quintiles, growth stocks outperform value stocks, right? So all these guys who were hung up on value, and you get a lot of articles out there, would have underperformed dramatically. Most people would have lost their jobs, right? Because they were hung up on buying the top quintile in terms of value. Last year or so, and again, it is volatile. Values come back very strongly.
Right. Yes.
And then there is momentum. So there is growth, there is value, there is momentum. So these are factors that you break up returns into. So if you are a quantitative, if you're a quant investor, if you want to make money relative to a benchmark over a short period, then you kind of look at these factors. That is more relevant to investing that is not prone to investor behavior. So if I'm a portfolio manager and I say this is how I invest, and this investment is prone to underperform for a while, so I can underperform for 3-4 years, right? Where the market is sitting on some different style, and it doesn't matter if it is my own money, but investors can just get out at the wrong time. Investors typically get in when the fund is doing very well. They get out of the fund is doing very badly, so they don't have to make money. Same happens in the market. So obviously, when as a house, we have two philosophies. One is this philosophy that I talked about, which is the core philosophy, which is what we like to run money based on. And the other philosophy is something called satellite philosophy, which looks at, for example, it looks at fundamental change, which again is fundamental momentum. So the belief is that if you see momentum, let's say Hindustan Lever has started seeing a reversal in terms of volume growth, you kind of expect that momentum that is being seen in the last quarter or 2 quarters will sustain for the next 3-4 quarters. Not necessarily so, but we're looking for rising or incremental fundamental changes is possible. We also look for rising expectations. We look at technical momentum, we look at relative valuation. We put all this into a quant model, and then we run it on the top 100 companies where the data is clean. And then we question ourselves, because we say that from on a short-term basis, this is how an analyst is supposed to think. So our quant model, the factors that we put in there is based on how the analyst is supposed to work when he's running money and when he has to outperform the index on a 3 to 5 year basis, or let's say on a 2 to 3 year basis. So then we have a different way of thinking, and they are not necessarily in sync. So for example, if you think about what I said, in the satellite model, we're looking for positive change, whereas in the core model, it is quite possible, and it has happened or it continues to happen, where a business is doing badly, and this is a phenomenal business. It's doing badly for certain reasons. Let's say there was a high base, so that high base was not sustainable. So the current earnings are seeing a decline, which is fine. It has nothing. I mean, the competitive advantage is not eroded, nor has the moat narrowed. Such businesses where you have, or there is a special situation, for example, where either a CEO was quit, or let's say in a pharma company there is an input alert, or it could be anything, right? There is COVID, for example. COVID is a special situation that impacted the market as a whole. It impacted certain sectors and businesses much more. Now, you could be very excited by this, and you will go and buy the stock. It is different from the satellite philosophy where we're looking for change, positive change. Here, we are okay to buy on negative change because the valuation suddenly becomes extremely favorable. So the core philosophy is different from the satellite philosophy. So momentum is kind of part of a satellite philosophy, which enables us to outperform over relatively shorter periods. When I say shorter periods, I'm still talking about 2 3 years, not months.
Right. Sir, so in your quant model, what are the technical indicators that are tracked?
They are mostly fundamental indicators. So basically, there are 4 pillars to it. Like I said, on fundamental change, we track change in sales, EBITDA margin, return on capital employed. Right? We also have sector-specific parameters. In an IT company, you would look at currency. Maybe in an auto company, you would look at volume growth, on which you have data on a monthly basis. Then we look at expectations. We're looking basically for upgrades and earnings. Right? Because what a stock, it is not important what growth we're building in. Or let's say you wanted 20% growth, but if the market is expecting a 30% growth, then the stock probably prices in that. So expectations is another factor when you're investing in the short term, which is why you often see that when a company reports good numbers, the stock actually goes down and people are surprised. They shouldn't be surprised because that was already in the price.
That was already priced in, right?
Yeah. And when I say momentum, technical momentum, we're basically looking at price change over a year relative to price change over a month. But that's a relative. We typically take out technical momentum and we look at change, expectations, and relative valuations. And we have a score. And then we put in momentum also, because momentum works in the very short term. And then we look at the score.
Right. I already know I'm going to be rewatching this 4 or 5 times once the recording is up. There's so much to unpack here. How do you think of position sizing and portfolio allocation?
So I think that is often underrated among mutual fund portfolio managers. I like to think position sizing is very important because you want to own, simply speaking, more of what you like. You want to own less of what you don't like, which is why you have to think in terms of what your number of holdings will be. So the top guys, like Warren Buffett, they own like 7 stocks, 9 stocks. In the Indian context, even 20, 30 stocks is thought of as concentrated. I don't think. I think anything about, so if you Google diversification, it tells you that it becomes out very significantly beyond the 15 or the 20th stock. Right? There's a lot of research papers out there. So I think 20 stocks is good enough in terms of the holdings, number of holdings you're thinking of. But within that, you obviously have a 10% limit, which is a regulatory limit, which also works well. So I think as an individual, you should think about, maybe I don't think this is the right thing. As in, if I were an individual, I would be very happy to own 40-50% of one stock of my holdings in one stock. Right? That is not something I would recommend. It all depends on your confidence at that point in time, at that price. So sizing after, so once you decide that this stock is a buy, sizing is almost as important. You come across so many people who are so happy with themselves that they got the call right, but they just didn't put enough money. Eventually, it's about how much money you make. So you identified a 10 bagger, and you didn't even put 1%. What is the point of taking credit for it? Absolutely no point. If you thought it was a 10 bagger, you should have bought 5-10% of the portfolio. 10 bagger is obviously 10%. So think about it like this, right? If you had a time machine and you could go to 2000, let's say 10 years down the line, 2032 or 2042, 20 years down the line, and then you come back. Now, how many stocks would you own in your portfolio? One, right? Because you go in 2032 and see which stock has made the most return, and you will come back and you buy that stock. Unfortunately, we don't have a time machine. We don't know what is going to happen then. That is the way to think about it, about holdings and sizing. So you've got to own more. It depends on your conviction. It depends on how. If you own a lot of the stock and the stock kind of tanks, that's a bad thing.
Right.
So,
Okay. So since we're on the topic, do you believe that diversification across sectors is a good thing? Is like a good hedge against one sector going under temporarily or something like that?
It depends on your time perspective, right? If you're trying to outperform a benchmark one, and you're trying to outperform the benchmark in a relatively short period, then you have to be cognizant of the risks that you're taking in terms of deviation against one sector. But if you are investing over a very long period, then it really does not matter. Then it comes back to the formula, the holy grail that I talked about, right? All that matters is about buying a good business and a good price at a reasonable valuation. But when you're running money like the way we run money, we have to be cognizant of short term, because investors keep coming, going. They don't have the time perspective that I'm talking about. They should. I think that people who do not, anybody who wants to come into equity should have a minimum time perspective of 7 years, if not long.
Absolutely. So since we're on this topic, I read somewhere that Peter Lynch's Fidelity Magellan Fund, it returned like close to 30% CAGR for however long it existed, but the average investor in the fund made a negative 11% return because they put all the money in when the fund was up and they took all their money out when the fund was down. So it's really important to stay in for the long haul.
Absolutely. Yeah. In fact, most people think fund managers are dumb. They buy when the market is high, they sell when the market is low. I don't think it's a problem with fund managers. It is probably, but it is also a problem with investor behavior. Money comes in when the market is positive, when everything is fine and markets are high, and money goes out at the bottom. Right? Because that's the cycle of greed and fear.
Right.
You are very fearful when things are bad. COVID, for example, when the market fell, people were actually wanting to get out, right? Which is also the reason why the market fell.
Right.
The market recovered faster, so maybe not many people exited. If you look at other crises, you will see people pull out because they're scared, they're fearful, they're losing money. Similarly, when the market is doing well, when things are hunky dory, paisa bhi ban raha hai, then people are very greedy. They want to make more money. जो equity जिसने सोचा ही नहीं है, the guy who was scared of equity suddenly takes out his fixed deposit and invests in equity after it is already delivered 100% return, because he sees his neighbor making a lot of money. It has to be the reverse.
Right.
You invest when you are fearful, and you sell when you're greedy. When you feel greedy. But human behavior is the exact opposite.
Right.
And these are, so investing is also about managing your behavior. In fact, it is more to managing your behavior rather than figuring out what to do. So what I talked about is it's not so tough to figure it out. So if you read annual reports, if you understand business models, if you read a lot, you will get there. It's about managing your behavior. Because you also don't know, right?
Right.
So
sir, let's say you have you've identified a good business, but you know it's going to be a falling knife for the next few months or maybe the next year. How do you approach buying it? Like do you average down? Do you average up once it starts going up? Because I think as a mutual fund manager, you once again don't want people leaving out the door just because they see the fund going down temporarily, because they're not going to stick around till the fund goes back up. So how do you approach that?
So this is an argument or this discussion I have with my analyst all the time, right? It's very relevant what you're saying. But think about your question. I've identified a stock which I think is very good.
Yeah.
At the same time, I think it's a falling knife.
Yeah.
What am I missing here? If I think, what am I thinking? I think the business is good and the management is good.
Right.
Either I'm saying the price is not good, or I'm assuming it is an implied assumption that the market is foolish.
Right.
मेरे को पता है, but market तो पूरा collective wisdom, मतलब मेरे जैसे तो हजार लोग हैं वहाँ पे, who are more smarter than me. They don't understand what I'm thinking, and they will actually bang the price down. Then I have to question whether the price is right.
Right.
So वैसा होना नहीं चाहिए, ये जो dichotomy है ना, ऐसा होता है. So you often buy a stock. What you are talking about, I get your point, because this is a very common discussion that we have. जहाँ पे analyst बोलता है कि ये 3 साल में डबल हो जाएगा, लेकिन 1 साल में 50% घटेगा. तो बोला यार हजार इधर से, अगर 3 साल में डबल होगा, तो कैसे, how can it fall? I'm avoiding Hindi, I guess there are a lot of people, I guess. सबको हिंदी समझता है क्या?
So there are some students from South India as well, so they might not be comfortable with Hindi.
Correct. So how can something that will go up 100% in 3 years go down 50%? Because then it has to go how much? It has to go 4x, right? From that price.
Exactly.
So how can the market allow somebody to make crazy money? And there could be some probability. It's always a range of probability. See, investing is you are expecting something, but there is a probability to it. If it was 100% probability, it would never be at that price, because there are other guys who will come and get that expected return down to cost of capital. मेरे को बैंक में तो 5.5%, let's say 7% मिलता है ना. अगर if I get some 20%, 26% for sure, वो 26% रहेगा ही नहीं, the price will come down. This is what happened to bonds, right? When yields go up, bond prices come down. When yields go down, bond prices go up. That's a perfect way to think about equity also. Why do bond prices go up and yields go down? Because it kind of marks itself to that current yield in the market, right? So equity valuation is similar to bond valuation. Bond valuation तुमको पक्का है पैसा वापस आएगा if it's a sovereign bond. Equity में you are thinking about it, which is why it is a probability. Your expectation is a probability range, and you have to figure out क्या है probability, best case, base case. Sorry, I kind of got kind of what was the question?
Sir, I just want to circle back a little. So, sir, what is your philosophy? Average down or average up after it is started performing again? So, like, do you buy on the down?
Yeah. So yes, question was, I'll come back to your question. I'll answer that. But so I think this is, you have to think about this issue itself, right? In terms of, you have to kind of question yourself: are you going wrong on the price?
Yes, sir.
Because, yes, sir. And then you still have to, let me finish that. So yes, I think you're thinking of earnings. It does happen. So market, a lot of the market is short term. When they say short term, it looks at quarterly numbers. So you know for sure that इसमें base effect है, recurring item था, जो आएगा नहीं, and the earnings will fall. Then the market generally, the stock doesn't perform generally, right? Doesn't happen all the time. Then you want to kind of time it, as in you want to wait for fundamental. Like I said, now think about the first philosophy, core philosophy, and the second philosophy. In the second philosophy, you're looking for incremental fundamental change. Your question pertains to negative fundamental change. So I will wait for negative fundamental change to turn positive, and then I will buy the stock, or I will size it up better, so that I'm managing the short term even within the longer term. So I hope that I answered the earlier question.
Now you will wait for things to get better.
I will identify. I will look for some guidepost on change becoming positive, earnings trending back. Right. I still own it. I like to own a core position and then build on it if there is negative change. Because once you exit the core position, because I have a lot of respect for the collective wisdom of the market. I don't believe that something will become so attractive, and a multi-bagger is never a multi-bagger when you buy it. It becomes a multi-bagger only on hindsight. Right. When you buy it, it's a range of probabilities. And wave function collapses. When the wave function collapses, it is either 0 or 1. So you're looking at a stock where it has become a multi-bagger, and there will be other examples where it went to 0. Right. So sorry, coming back to this question on averaging. Okay, this is very funny. So if you look at my trade data, you will find that I'm always buying at a price higher. It means that I'm averaging at a higher price.
Okay.
Which sounds dumb. And I tell you something that sounds even dumber. I'm also selling at a loss most of the time.
Okay. So I think like the trader will say average up, and once it starts going down, start selling, and the contrarian investor will say that buy on the way down and then sell later on. Like the moment.
So for example, we made a lot of money on Page, right? So we started buying Page at some $550. We bought it all the way up to 1,200.
Right.
Eventually the stock went up to whatever, 30,000. But we were buying at higher prices.
Right.
There was also a liquidity issue, but we were averaging higher. And then there have been stocks like Bail and many stocks where I bought it higher and I sold it, exited the stock 20% low. Now think about what I'm saying, right? It might sound contradictory, but basically what happens is the market is very smart. What you know the market knows, largely speaking. You have a slight edge because you think otherwise there's no point being in the market. When fundamental change is positive, the stock reacts to it.
Right.
Which means the stock, so if I bought something expecting that numbers will be good, the numbers are good, it's out there, and the stock does better. Why didn't I buy all of my positions? Because I wasn't sure. For me, it was a probability matrix. Now I see the numbers coming, so I get more confidence in my thesis and I buy more.
Right.
And then things become better, I buy even more.
Right.
So I'm averaging higher. Why do
Right.
I sell at a loss? Because I've gone wrong. When I've gone wrong, I'm not supposed to be stuck to my cost price. Doesn't matter. The color of money is the same.
You want to cut your losses?
Absolutely. I cut my losses. So there are three reasons why we sell. One, investment thesis goes wrong. It goes wrong all the time. Fortunately, if you go right 6 to 7 out of 10 times, it's a fantastic number. 60 to 65% probability is a wonderful number. It is even better in a public market setup, unlike a private equity, because you know when you're going wrong and right. So you can make changes. So if you take the wrong route, you can go back and take the right road. As in sell the stock, go back to your thesis. So which is why this whole averaging thing is more of a trading. And there's a big difference between what I'm saying and what a lot of people out there would say. It's not like they're wrong or I'm right. It's just like you're getting a perspective from a trader, whereas I'm talking about investing. My perspectives are totally different. I don't trade. I like to think I don't trade. Yeah. 1 second. Put your bell mark. Ishant. I think I'll need to open the door. Excuse me for a bit.
No problem, sir. We'll be right back with the session. Meanwhile, if you guys have any questions, please feel free to post them in the chat. We'll select the best ones and ask them at the end of the session.
Yeah. Can you hear me now?
Yes, sir. Okay, so to sum up, no problem, sir. So to sum up, you average up and you cut your losses. Right. Okay. So, sir, as a fund manager, how often are buy and sell decisions made, and in what proportion to the position?
I mean, there is no single answer to the question. Depends on the fund that we're running on. The larger funds, turnover ratios are 25%. And on the smaller funds, we also run, on my funds, it's closer to 70-80%. On some of the other funds, it's even exceeds 100%, depending on the strategy that we're running. So on a contra fund, we join quite often. We're looking for small upsides, and the moment we get that upside, we get out.
Right.
we're also going down the quality curve in a way. So we're also quick to change when the thesis goes wrong. We don't lose too much money.
Right.
Whereas in a fund where we are looking for long-term compounding, the return is typically pretty low.
Right. So, sir, since you're running so many different funds with different philosophies, how do you manage to balance it all these different philosophies and ideologies?
So at the core of it, or the philosophies, so these are the two philosophies. अभी वो बोलने के लिए you run a, when you say large cap also is classified as a separate strategy, right? Small cap is a separate strategy. Now, I don't think a small cap and a large cap is really different, because the whole so you're going back to the core philosophy. How does it matter whether the stock is a large cap or a small cap? It's just that you have more confidence. You think that maybe competitive advantages, you will have more companies in the large cap space that have competitive advantages, right? That doesn't mean that businesses which are in the small cap space do not have competitive advantages. You will find fewer as a percentage. The number of companies is larger. Right? So we bought a small cap which is gone up by 10 times. Even when we bought it, they had a 35% market share in the limited space they were in, which was catering to a larger space. So they used to make tire, lead wire, which goes into the tire, between the tire and the rim. That's it. वही product बना रहा था. तो वो tire companies को service करते थे, top tire company. तो जब हम खरीदे तभी भी market share उसका अच्छा था. वो बढ़ गया उसके बाद. Think about an ancillary company which supplies to Maruti. Of course, there is a B2B issue there, but they supply to a larger sector where the demand is growing. So when you say different strategies, one is strategies which are based on market caps, so they're not necessarily different. If your philosophy is basically about identifying a stock based on the business model, then there are also some strategies we run. So there is a contra fund that we run. So basically, mutual fund with SBI has given us the list of funds that we do. And थोड़ा सा concept fraud है. Record public because see, there is a mutual funds also in the business of making money by managing money, right? So if you ask me, should there be so many products out there? No. Is there demand for these products? Yes. So you have them on the shelf, but if I have to justify them, I don't have a very strong justification for having so many products and strategies out there.
Right. Okay. So, sir, what is your playbook for a recession or like a recession-like environment? Like recently, there have been lots of layoffs and interest rates have been hiking, so people are anticipating a recession. So, what are your thoughts? Like, how do you approach a recession, and do you again like in the coming months or the coming year, do you see any situation like that forming?
So this is specific to me. I'm not so much of a top-down guy. Not that the top-down, not that I don't have a top-down view, but I don't have respect for my view. So I'm more of a bottom-up investor. As in, I can talk to you more convincingly about why I own a stock, rather than tell you what I think about the economy. It again goes back to that probability thing, right? It goes back to the probability thing where, so when you think about making money, right, there are three ways you can make money. One is stock selection, where you buy a business, hang on to it. Okay. Second is you buy a team or a sector. You identify a team which is buy a basket, or you allocate within sectors, which is like a combination of bottom up and top down. Second is market time. A lot of people do market time, which is what you're saying that you based on top down factors, and you're saying that the market will go down or the economy is bad, and you have that perspective, and you then reallocate between equity and debt. So you will go to 0% equity at some point. We also run asset allocation strategies, for example, which are based on these factors. Now the thought process across all these are very different. So the way we will react to an expected recession will be different based on the strategies that we manage. So on the top down asset allocation strategy today, for example, so we have an asset allocation model which we back tested and we think works well, which is based on earnings, valuation, and sentiment. We created our own proprietary sentiment indicator. We also have an earnings indicator, which is both micro and macro. The macro looks at the yield curve, rates, sentiment, global consumer sentiment, and stuff like that. And the micro is basically summing up the sell side or our own estimates on earnings for the Nifty. And there is valuation where we look at something called the Schiller PE, bond yields, right? Where we're looking at the Schiller P to account for earnings cyclicality, and we're also taking out bond yields to account for rates. So we put in all this into a model, and the model today is telling us that we should be underweight equity. So on the 50-50 equity debt benchmark, the model is telling us it should be 20% underweight equity. So we should be 40% equity. Say. The model also goes to 0 and 100 at some point in time. So that influences our view. So when I'm running a bottom-up strategy, for example, this view may or may not influence me for the one the cash that I own. So because we can go up to 10% most funds, the last fund we can go up to 5-7%. So this view will decide how much cash I have. This view will decide whether my portfolio is defensive or aggressive. So if you break up the portfolio into defensive, cyclical, and the financial is kind of cyclical but different from cyclicals. So you can analyze where I'm overweight and underweight depending on the macro perspective of the markets. And the third would be, for example, if I'm confused about markets, I don't know where the markets are going, which happens a lot of times. Then I might just run. If I'm also looking at short-term outperformance relative to benchmark, then I might run a low active share. Running a high active share means I have high tracking error. High tracking error means my ability to generate excess return goes up, but I'll also make negative excess return. So I reduce my tracking error. I hope you might not go down to answer, but yeah. So then these are the three ways we will try and manage the macro view, for example.
Right. So this pretty much covers my next question, which was again what you think of the macro factors. So I'll jump on to my next question, which is how do investment ideas appear on your radar, and how is your investable universe screen? You went over it a little bit in the beginning, but if you could expand on that, it would be great.
So we run screeners. There are a lot of screeners that you can run. I mean, even you Google, you get a Petrosky screener. But simply speaking, so when I'm looking for a good business model, right? So if there are, what is the number that defines a good business model? The competitive advantage, the economic mode thing is still a qualitative discussion. But I can look for businesses that have been generating higher return on capital employed for a long time. I can screen for businesses. So we do this for the Indian universe. We've been around for a very long time.
Yes.
So I've been like in the market for 30 years. So I practically have met every company that's out there and that is new. And I have a sense on the sector and the cycle, like broadly speaking. But let's say I do the same thing for an international. We also do buy stocks outside India, global stocks. What we would do, for example, or what we've done is to curate the universe, because we can't go and look at all the stocks out there. It's a very cumbersome task, right? To read the annual reports, understand the business model. So we just run a screener based on the growth sustainability. Over the last 10 years, which are the businesses, for example, that have grown at more than 7%?
Right.
Which are the businesses that have grown at 7%, also generated CFROI, cash flow return on investment, or purely return on capital employed. And then you can put in more factors like leverage. So you don't want to buy high leverage businesses, so you have a cutoff in terms of leverage. You don't want to buy businesses which are more than 1 times leverage or say 0.7 leverage.
So sir, if I understand you, if I understand you correctly, you're not looking for hidden gems. You're looking for companies that have been consistently outperforming or meeting those criteria for a long period of time. Is that so?
That is definitely a starting point. If you want to look at a market which you are not very familiar with, it is the starting point. It's safer to invest with businesses that have delivered in the past. Past track record is a very important input that goes into. In fact, there is a certain section of investors, and we debated this, and I have a lot of regard for them, who do not project at all. They only look at past numbers.
Right.
There is a bit of an extrapolation risk there, but somebody who's done 20% growth for 20 years or generated a 20% return on capital employed for so long, he's doing something right? They go and figure out what he's done. But screen करने के लिए, so that is the first point you want to look at, right? And then you go deeper and figure out why he's done that. So today, for example, in the banking sector, SBI Bank shines out. Clear. So to screen करोगे growth or return on equity, he'll stand out. All the others will kind of go away. So he's done something, and now we can decide whether there is a competitive But
so
you
you
talking about screeners, right? So these are starting points. We obviously also, I told you about a quant model, right? So the quant model also, the variables that I talked about gives you a sense on what we are looking at in terms of what works. So we will also screen based on those are all part of the factors. So we will also screen based on those factors. So
Right.
anything that appears in the top quintile of my quant model is the stock that I need to look at. If I'm negative on that, I'll question my analyst or myself as an analyst. Why am I negative?
Right. So you screen for ROE, ROC, and generally look for numbers north of 20%. Is that so?
15, I would say. 20% was maybe years back. Yeah, our return expectations have gone down dramatically.
Right. And then you will wait for them to come to like a reasonable valuation, or like would you buy at the current price?
No, these are only starting point. These are screeners. And
Right.
eventually we'll have to go down deeper and understand the business model, meet the management, or see what they've been talking about in the conference calls.
Right.
Then it will involve a bottom-up analysis of whether we like the stock, whether we want to buy it. Screener is only to, so you have like 1,000 stocks out there, right? 1,000 stocks.
Right.
Very much small cap fund. And I'm
Right.
looking for ideas because I'm running short of that limit. And I will screen the small cap universe.
Right.
And then go deeper into the stocks that figure well in these parameters, including valuation. We will also screen based on valuation.
Right.
Low PE stocks, low EBITDA stocks, low price to book relative to return on equity.
Right. Right. Sir, is there a risk of the multiple derating in case the growth decelerates in this process?
Of course. Multiple is a function of growth, return on capital employed, and cost of equity. Anything changes, your multiple will change. Again, a multiple is a heuristic, remember. It's a shortcut. Multiple क्या होता है? P multiple. If you pay 20 times P multiple, you're paying 20 times current year earnings.
Earnings, yes.
उसका क्या मतलब है? उसका क्या मतलब है? उसको कोई मतलब नहीं है. 20 times क्यों दे रहे हो? 10 क्यों नहीं दे रहे हो? 50 क्यों नहीं दे रहे हो? Right. So that multiple is a function of growth. That multiple is a function of return on capital employed. It's a function of cost of equity. A business which grows less than return on capital employed does not require capital. If your return on capital employed is 20%, let's assume you don't pay out dividends, then the moment you grow at 30%, the 10% has to be funded. That funding has to come from either equity or debt. Now, if you think that 30% or 10% additional growth may be 20% return on capital employed, and your cost of debt is 9%, then you get 11% on 10% additional. You think about it, it's orgasmic. So that combination growth, so valuation eventually is a function of. So think about what goes into these multiples rather than being hung up about multiples. Unfortunately, novice investors at least are just hung up the multiple area. Multiple area comparison area. Those are shortcuts. If you really want to succeed and do well over a long time, you cannot do shortcuts. As with anything in life, I guess.
Right. So, sir, with these consistent compounders, like you've been in the space for 30 years, how much would you say of the return comes through dividends, and how much of it comes through the price movement?
In India, it's largely price movement and growth. When you say price movement, you are also implying that there is no overvaluation implied. So over a long period, let's assume that the price movement is consistent with growth, which is how it should be, right? So if you look at one thing you guys should do if you're interested in investing, in fact, that is what you should start with. You should read these Buffett letters to shareholders. If you go to Amazon, you get it for free. Right from 1965 or 57 to 2022, all these letters are available in a very fat format. These are letters that he written to shareholders, and you should start from the first letter and you should go on and on. One thing you clearly notice that he gives in the first page, book value.
Yes, sir.
And the growth in book value. And the growth in Berkshire Hathaway.
Right.
So eventually, the growth in a stock price, in fact, what is he implying? He's saying that any value accretion in a stock is a function of what? Accretion in book value over longer periods of time.
Right.
So when you're saying that price return, what is it a function of? Eventually, it's a function of growth in book and the the price at which you bought is obviously relevant, but the stock will move in line with the growth in book over a very long period.
Right. So sir, we circle back a little bit, like how much of the expected return is from dividends and how much is it from the growth?
In India, it will be largely growth.
Largely growth because it's a growth profit.
It is a growth profit. Yeah.
Okay, sir. So just doing a deeper
But that
dive.
will vary. That will vary depending on stocks.
Right.
Obviously.
So we've gone over a little bit over your checklist. Would you like to expand on that,
On our checklist,
or is it proprietary?
really, there's nothing proprietary. Could proprietary. Yes, everything is out there. So checklist is the same thing that I talked about, right? We have like a 27-point checklist which covers what constitutes a good business, which constitutes. I talked about it.
Right. So where can we find this 27-point checklist?
मैं भेज दूंगा है.
Okay, sir. Okay.
Yeah.
Okay. Thank you so much, sir. Okay. So, sir, what are some red flags in Indian companies that we should always, beware of?
So we have a forensic model where we're looking at close to 18 factors to identify red flags. बहुत सारे हैं, so you should look for accounting gimmicks, for example. You should auditor अगर खराब है, then you should be worried.
Okay.
If the company is generating accounting profits but is not generating cash flow,
Right.
you should raise your antenna. Right. Suzlon was a perfect example. Suzlon had very high had high margins, but it used to make negative cash. If the company is making negative cash because it is growing higher than return on capital, is a different point. That is fine, right? But if you are generating return on capital but not generating cash, then you should question because वो कहीं तो working capital पे जा रहा है, या तो वो पैसा आया नहीं, so उसको account कर लिया, the money has not come, so cash flows. So you have to look for cash flows, not really. You have to segregate accounting profits. You have to look for goodwill, for example. You have to look for miscellaneous expenditure as a percentage. यहाँ पे क्या छुपा रहा है. Then there are outright frauds here. Satyam, for example, is an outright fraud. So what we do as our basic assumption, we go by the assumption. अब मैं तुमको ध्यान दे रहा हूँ, but हमारा basic assumption है कि हमको बताएंगे क्या होगा. मतलब the stuff that we don't know is like a very significant multiple to the stuff that we know. So how do we ensure that you reduce that multiple, or you increase the stuff that you know? So we do a very strong, you call it scuttle part, for example. We have a very strong channel check system that is integrated into our investment process, where कोई कंपनी को मिला तो मैं उसके कॉम्पिटिटर से बात करूंगा, उसके कस्टमर से बात करूंगा, उसके क्लाइंट से बात करूंगा, वेंडर से सबसे बात करूंगा. I will look for people उसके ex employee से बात करूंगा. I look for people who bitch about it. Right. Then you get a better sense on the whole thing. So this is a subjective way to look at the business, but I think it is very, very important. That is also it gives you red flags. तुम 10 जन से बात करोगे तो तुमको पता ही चल जाता है जो.
Right.
It's not necessary because कभी-कभी लोग अच्छे होते हैं, they start well, they do a good job, they get carried away, and then they take it to the other side.
Right.
So it is not completely foolproof, but you've got to be at it all the time. Because the crooks are also very smart in terms of their ability to talk to you and sell.
Right. So, sir, there was this company that I had been tracking, and an ED CBI case had come up where the promoter misappropriated companies' funds to buy farmhouses in Delhi and supercars. And so, is there something you can know are there some telltale signs that you can know in advance in order to avoid such companies and such promoters?
Yeah, so high lifestyle होता है.
Right.
These are obviously things you should look out for. Standpoint promoter है. Vijay Mallya is like a perfect case in point, right?
Right.
It was staring in the face.
Right.
हम लोग नहीं करते थे. और अगर कर भी रहे हो ना, ऐसा नहीं है इन्वेस्टिंग में तुम कुछ भी कर लोगे. Eventually you're there in this business to make money, right? As long as you're cognizant about it.
Right.
तो तुमको लग रहा है कि लफड़ा है, तो ideally stay out.
Right.
But if you get in, then you be cautious.
Right.
That is the advantage of public markets. This is not something. This freedom is not something on private equity because liquid है नहीं, तुम निकाल नहीं, you can never exit.
Right.
But then the moment you take speculate on
Right.
integrity of the promoter.
Right.
Then the probability of you going wrong is very high. And once you lose money, it's very tough to kind of. So if you have to make like 20% returns, you have to double money every 4 years. उसमें
Right.
अगर कोई स्टॉक 10% उड़ गया, फिर उसको फिर you have to generate another 20%. The part of the portfolio is that, then you have to generate 30% return. वो सब possible नहीं है.
Right.
It's tough. So not losing money is a very
Right.
huge part of generating long-term returns.
Right. 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 Okay. So you recommended narratives and numbers by Ashwath Damodar, and you recommended the Buffett letters. So my last question is, if you were to start all over again, what are the books and resources that you would recommend to let's say 20, 30 years ago, like if you had to talk to a younger self, or if you had to talk to your son or us, what books or resources would you point us to start our investment journeys?
See, I will not वो जो books जो सब लोग बोलते हैं, intelligent investor हो गया, वो सब I will not talk about वो तुमको पता ही है, Google करो तो you will get all that. So those are basically stuff that teaches you about basics of investing, right? But what I would strongly recommend, what I would have done differently, and what I think I've gained from, is reading stuff that is even not related to investing. Because it a very overall sense, investment or investing covers a lot of topics. Right? It covers behavioral. So Dan Kahneman, you should read this book, Thinking Fast and Slow. It is to do with behavioral. It's a brilliant book. It's very dense and very light at the same time. उसको 2-3 बार पढ़ो तब कुछ समझ में आएगा. And so you read books across psychology. You read books on science, for example, scientific method. So if you read this book, this is an amazing book. Whether you are looking to invest or not, 6 easy pieces. This is Feynman's word of Feynman, right?
Yes, sir.
Yeah, correct. So if you read 6 easy pieces, he talks about patterns and stuff. But when he talks about the scientific method, there are insights that you get, which will be relevant to investing in some way.
Right. Okay. That's the end of my questions. So I'll just take some questions from the audience. So we have selected some questions, but feel free to post your questions in the Q&A, and the ones we like best, we'll ask, sir. Okay, sir. So what is the role of data science and statistics going forward in the mutual fund industry?
So it's increasing significantly. We try and use data. We have a guy, for example, who I think artificial intelligence is a very strong word. I guess machine learning is something like that. So, for example, COVID, when China, when you had, so we were just debating, and he did this Google. He had his Google data, which showed that the traffic in China was 80% lower than what it's normally at those times. So China was saying that they're not under lockdown in this data.
There actually was a lockdown.
He did that, and we didn't get it from outside. He did that himself. So you can do stuff, for example, you can do tracking on toll nakas if you really want to buy a stock that is related to that. We, for example, do you guys use IMDb? I love it.
Yes, sir.
IMDb
yes, sir.
called a meta score. So
right.
It basically combines a lot of different scores. Like somebody saying 1 to 5, somebody saying ABC, somebody saying 1 to 3, somebody saying only subjective words, and they combine it to a score. So we are trying to do a bit of that. We run a program which scrubs across websites and gives us some ideas on what is being talked about. So if there is stock that we own, it scrubs across relevant websites and tells us ये stock के बारे में कौन क्या बात कर रहा है, and it kind of throws up all that data to us. There is we run conference calls, transcripts, and we use linguistics. I think all that software has become very advanced now, where you can look for sentiment, positive sentiment. So that tells us you can go and you should go deeper into this stock, because last 2 quarters they're talking positively, and then see whether this can be an idea worth exploring.
Right.
So these are multiple stuff that we're doing apart from the quantitative stuff that I talked about, which obviously involves data science, statistical software, and I guess it is the tip of the iceberg. I think a lot of
what we do, what you guys, I think a lot of what people do in general will get automated and move to machines. Obviously, there will be a part which is the software, the art part which will not. So all that replicable stuff, including the stuff that we do in investing. So when I talk about, for example, how an analyst is supposed to think, if I'm able to map it into a quantum model, then it is a machine doing the job for me in a better way, right? But I cannot completely depend on the machine because there are subjective aspects that I talk about. So data science will play a very important role.
Right. So
this is the type of investing I'm talking about, which is qualitative. Data science already plays a very significant. In fact, you know who the best investor today is out there?
Rentec, Renaissance.
Renaissance, right? James Simmons.
Yes.
And, I mean, you know what return he generated? I mean,
70% without fees, 40% net of fees.
Mind blowing, man. 20 साल से कर रहा है.
Yes.
Yeah, it's crazy. And you know what it is? You read this book, the guy who solved the market.
Yes, sir. I think it's question correctly.
Some insights into what they do. Nothing fundamental.
Right.
I'm not saying it's technical, but they basically look at data, pure data, and they dump all that data, and they figure out patterns that make returns, and those patterns would last from a few hours to a week.
Right.
And then they use those patterns to manage high churn portfolios, which is generating some mind-blowing returns. Warren Buffett, none of these guys are even close. But obviously there is a size constraint.
Right.
So the money is.
I think in the previous annual Berkshire annual shareholders meeting, they finally talked about Jim Simons, and they did say that he runs.
Mind blowing, yeah. How can you generate? It is like totally godly.
Right.
So that actually, that is like a perfect answer. That tells you.
Right.
Obviously, these guys are all PhDs and completely different caliber.
Yeah, astrophysicists, Nobel laureates, and it's close to outside investors. The fund only the employees and
because they have a size constraint.
Yeah.
Because they have a size constraint. Because the moment you increase size of the strategy, the size will arbitrage out the data.
Right.
Size की वजह से रिटर्न नहीं मिलेगा वैसा है. Arbitrage का वही है ना, जितना ज़्यादा पैसा arbitrage नहीं है.
Right. Okay. Okay, Ritam has a question. Do you have a general opinion on Indian penny stocks?
Penny stocks are avoidable.
Oh, avoidable. Okay. All right. So Harshal asks, what's your take on the new age startups like Paytm, Delivery, Nykaa, all of these people?
I cannot. There is no generic. I think, like I said, you got to look at every business, apply the same philosophy. So we don't like Paytm. Fortunately, we didn't invest even for a flip. We like Delivery. We own Delivery.
Okay.
Not a bit of money, but we think they're doing wonderful stuff.
Right.
So
okay,
they're all different. So they're all bottom-up calls. I can speak at length on every stock. I can speak 1 hour on Delivery, what I like, and then it can be an interesting debate too. But yeah, maybe you can look at it as some sector, and you're not taking it as a theme.
Right. Okay. So the students want to know how can they make a career in the mutual fund industry. Do you have any tips on that?
I don't have tips, but I think the best way to get into, let's say, you want to become a portfolio manager or fund manager, then you should be a good analyst. I think it is basic hygiene. If you're a good analyst, it doesn't mean you will be a good portfolio manager, because the analyst gets the depth aspect of it. The portfolio manager understands the breadth. You need both depth and breadth to make money, right? So it is good to start off as an analyst, learn the grind. You can start off in a KBO, which caters to the sell side. You should ideally move to the sell side and work with good sell side firms. The advantage there is that you're always on your toes, because you are meeting guys, buy side guys who are out to screw your happiness. Right? You're writing reports, your view is out there. Whenever you write something and it's public, it's a very different rigor that goes into that data and that analysis. And then you get into the buy side, you become an analyst, and then eventually you become a portfolio manager.
Right.
That's the funny. Obviously, you do your academics, CFA and stuff.
Right. Okay. question I missed in the beginning. We were talking a lot about what strategies have worked in India and will work, value versus growth. And so I wanted to ask, do you feel that cigar butt investing works in the Indian markets?
Cigar butt investing works. What is cigar butt investing? Basically saying that इसमें एक और profit है.
Right.
इसमें इतना so that's the gap between value and price. Right. You perceive a lot of value, and there is a price which is like a very significant discount. The only thing you got to keep in mind is that you have to be able to unlock that value. Who will unlock that value is the question, right? Promoter अगर पैसा लेके वो आगे then that's the problem. But if you are able to unlock that value, then it makes sense. So you're buying something that is worth 100 rupees at 30 rupees, and you will get that 70 rupees.
Right.
But the time it will take will eat up on your cost of equity. So you have to be sure that it makes common sense, right?
Right.
It's basically deep value.
Right. Right.
But you don't buy it for the sake of it.
Right. Right. So let me just see if we have any other questions. What do you think about options, futures, and derivatives?
There needs to leverage your positions effectively. I mean, in a mutual fund setup, we're not allowed to leverage. Whatever derivatives we do, the cross position gets captured, and we can't exceed 100%. So if I have 10% cash, for example, I need to use 1.5% cash to get to a 10% overall position, but I cannot exceed 100% of the fund, so we cannot leverage. Individuals can.
Right.
So we only use derivatives as a liquidity option because the cash market is not available. Options is a liquidity issue, but these are instruments where you can make excess return as long as you understand it and the price that you pay for it.
Right. Right. Okay. So I think we've covered all the questions. One last question from me is, if we have a thesis for you, how do we get in touch with you? How do we email you?
You have a thesis for me, Madam?
I have a stock thesis for you. How do I get in touch with you for that?
You have a stock thesis for me, as in what you're selling me a stock.
I'm giving you a stock idea for the fund.
Okay. You can email me, or
okay.
Or you also can message me, I guess.
Okay. So would you like to give the email out? Or okay, fine. I'll get in touch with Venkatesh.
Yeah. Or the problem where also email आता है, so I might miss it also.
Right. I'll run that risk.
Yeah.
Okay. All right. Thank you so much for your time and all of those pearls of wisdom. I hope you all really enjoyed this session. I'll just hand the stage over to Kunal for a vote of thanks. Thank you so much, sir.
Thank you. अभी सबको मैच देखने जाना है.
Yes, sir. Yes.
Yes, sir. Match is at 8:30. So just one final vote of thanks. Along with it, I would just like to share our daily quiz winner. So basically, we had a daily quiz encompassing around 10 finance questions spread out over 10 days. The students were asked to give answers to the questions along with some explanations to them. They were MCQ based. So I would just like to share the winners. And I don't know if they are here, but the first prize winner is Viral Jenny, and the second one is Mritul Saraswat. Congratulations to you all for participating in the daily quiz. You all receive a 1-year TT Prime subscription and 1-year Time Prime subscription respectively. So yes, we'll contact you after the session. So just closing up, I would like to extend my heartfelt gratitude to Mr. Srinivasan sir for having attended and enlightened us with your knowledge in our humble event. It was truly a pleasure to have you, sir. I would also like to extend my thanks to everyone here for being a great audience, asking great questions, and attending this session again. I would also like to thank the IITM POD team for helping us conduct the session, and also the Sundarbans Finance and Corporate Club. I would also like to thank Mr. Venkatesh Yengar for setting up this event, and Anshuman for being an amazing host and asking great insightful questions. At last, thank you everyone in all, and thank you everyone for attending. Thank you, sir, again.
Thank you. Bye.
Thank you, sir. Thank you so much.
We can stop the recording now. Just text.
एक मिनट सर को टेक्स्ट करता हूँ. Okay, I think Rajan has a question. Rajan,